So imagine two 25-year-olds, right? And they have the exact same salary.
Okay, yeah.
Fast forward 30 years into the future. One of them is living totally paycheck to paycheck, just stressed about the next billing cycle.
Right.
But the other one is sitting on this, like, multi-million-dollar portfolio, completely financially independent.
It's wild, but yeah, it happens all the time.
It really does. And so welcome to today's deep dive, where your mission, our mission for you, the listener, is unpacking the single, completely unglamorous machine that separates those two people.
Yeah, unglamorous is definitely the right word for it.
Totally.
Yeah.
We are talking about the stock market. Specifically, we're looking at why this incredibly accessible tool is just systematically misunderstood or, feared by people who could really use it to change their lives.
Yeah, and I mean, when you look at the data analyzing that massive gap between those two 25-year-olds, the immediate human instinct is to, well, search for a hidden advantage.
Like they must have won the lottery or something.
Exactly. People assume the millionaire had, like, asymmetric information, or they took these massive speculative risks, or maybe they just had some elite economic forecasting ability.
Right.
But the reality of the data just strips all of that away. The divergence is actually driven by a mathematical certainty combined with behavioral discipline. The secret ingredients are really just time, consistency, and compounding.
Okay, let's unpack this, because if the blueprint is seemingly this straightforward, like just allocate a percentage of your capital, buy broad equities, and wait.
Yeah, just wait.
Why is there such a massive psychological barrier? I mean, we are talking to an audience today that understands what compounding is on a surface level.
They know the math.
So why aren't they executing on it?
Well, it's because human neurobiology is fundamentally misaligned with the mechanics of long-term compounding.
What do you mean by that?
I mean, we are hardwired by evolution to optimize for immediate feedback loops, right? If you forage for food, you eat today. If you run from a predator, you survive today.
All right, it's all about right now.
Yeah, exactly. So when you require a human brain to defer consumption now for a reward that won't, like, fully materialize for 3 decades, you are fighting millions of years of evolutionary programming.
Wow, so it's not a math problem at all.
Not at all. The intimidation or just the failure to act, it doesn't stem from an inability to understand the numbers. It stems from the immense behavioral endurance required to just let the math operate without, interfering with it.
Yeah, we know time is the differentiator, but let's get into the actual mechanics of what happens during that time. Mathematically, what is time actually doing to the money?
Well, that brings us to the compounding part, which honestly feels agonizingly slow at first.
It really does. People call it the eighth wonder of the world, but the first decade feels like a crawl.
It's almost boring, yeah. You are funneling capital into the market, and the organic growth on that capital feels like a rounding error compared to what you're actually putting in.
It's like planting a tiny seed for an apple tree. You spend the first few years staring at a pile of dirt.
Just watering dirt.
Right. Which is incredibly boring.
Yeah.
You're protecting it, but all you see is dirt because the growth is entirely subterranean.
Yeah, and what's fascinating here is that the subterranean phase is where the mechanical leverage is actually being built.
How so?
Mostly through dividend reinvestment and corporate capital allocation. During those early years, your absolute dollar returns are small. But if you're reinvesting your dividends, you're using the cash flow from those businesses to automatically buy more fractional shares.
So your ownership is quietly expanding.
Exactly. Because compounding is an exponential curve, not a linear one. In year 5, your returns are just a tiny fraction of your portfolio.
Barely noticeable.
Right. But by year 25, the interest and dividends generated in a single 12-month period will likely, eclipse your entire initial capital contribution.
That's insane to think about.
It is. But the math requires a critical mass of capital to reach that inflection point.
But when the growth is that slow in the beginning, isn't it incredibly tempting for someone to just pull their money out and buy something tangible right now?
Oh, absolutely. It happens all the time. But delaying your start date or pulling money out because you're bored staring at the dirt literally amputates the back end of that exponential curve.
And that's where all the magic happens.
Exactly. That's where all the explosive growth actually lives. You rob yourself of the acceleration phase.
And that slow, boring first decade creates a massive psychological trap, doesn't it?
A huge one, yeah.
Because beginners get bored waiting for the apple tree. They start looking for shortcuts. They want that immediate dopamine.
They want the excitement.
Right. So they abandon the boring process and start treating the stock market like a casino. They chase whatever hot stock or social media tip is trending.
This is the critical mindset divergence between retail gamblers and true generational wealth builders.
The gamblers are just looking for a quick payout.
Yeah, the gambler treats a share of stock like a lottery ticket. Like it's just this digital token that magically goes up or down based on vibes or sentiment.
Right. But the wealth builder sees it differently.
Completely differently. The successful investor views it as ownership. Buying a share of an index fund isn't a speculative wager. It's buying a fractional claim on the future free cash flows of real operating
So
businesses.
you're buying into companies that, like, have fleets of trucks and proprietary software and global supply chains?
Exactly. Businesses that sell real products and generate profits 24 hours a day. When you shift your framework from guessing which ticker symbol will spike tomorrow to accumulating productive assets over time, you insulate yourself from all that noise.
Here's where it gets really interesting, because that shift completely reframes things. You aren't betting on a horse at the track hoping it crosses the finish line first.
Right.
You are buying a brick in the racetrack itself.
Oh, I love that analogy,
Every
yes.
time a race is run, every time a hot dog is sold in the stands, you are capturing a microscopic fraction of that economic activity.
And that structural perspective is exactly why long-term equity holders win. Let's look at how that racetrack generates yield for you, even if the stock price is totally flat.
Wait, even if the price doesn't go up?
Yeah, through massive stock buyback programs. Lots of these companies use their profits to repurchase their own shares from the open market and retire them.
So there are fewer shares out there.
Exactly. So if you just hold your shares and do nothing, your percentage ownership of that company inherently increases. You're getting a larger slice of the pie without lifting a finger.
Wow.
But you only get that if you stay invested and let management execute their long-term strategies.
I have to push back on this, though, because the allure of the shortcut is just so strong. But what about those overnight success stories we always hear about? It's hard to ignore the noise.
It really is.
Like, you open social media and someone is bragging about turning 10 grand into $500,000 in a month by timing a short squeeze. That makes the steady business owner approach feel almost naive.
Well, you are describing survivorship bias, and it's heavily amplified by algorithmic media.
Mm,
The algorithm surfaces anomalies because, well, anomalies get clicks.
so we only see the winners. Exactly. You see the one guy who used crazy leverage and bought an island. You don't see the millions of silent retail traders whose accounts went completely to zero trying the exact same thing.
Because nobody posts about losing everything.
Right. In the financial markets, risk and reward are inextricably linked. The person pulling off that massive short-term gain took on a catastrophic level of risk to do it. It's basically statistical suicide for your money.
So treating it like a casino is a guaranteed way to lose eventually.
Predict tomorrow at your own peril. The historical data is clear over a 20-year horizon. Even the vast majority of active fund managers, people with supercomputers and Ivy League degrees, fail to beat a basic index fund.
So what does this all mean for the listener when they see their portfolio drop by 20%?
Ah, yeah, the drawdown.
Because understanding ownership is great when stocks are going up, but when the news is predicting disaster and your account plummets, it is terrifying.
Fear definitely keeps people away or makes them sell at the worst possible time.
Wait, if the market drops, isn't sticking cash under a mattress or in a checking account the only truly safe option? I mean, at least the number doesn't go down.
This raises an important question about how we fundamentally define risk. It is mathematically true that cash or a short-term treasury bill offers a nominal guarantee. You put $100 in, you get your $100 back.
The number stays the same.
Right. But we have to look at real returns, not nominal returns, because the silent thief here is inflation.
Right, purchasing power.
Exactly. If you're generating, say, a 5% yield on cash, but inflation is running at 4%, your real return is exactly 1%. And that's before taxes. You're just treading water.
Which means the traditional definition of safe is completely backwards.
Completely backwards.
If your purchasing power is turning negative because of inflation, you are locking in a mathematical certainty that you won't have enough money for retirement.
Precisely. Avoiding the market isn't safe. Over a multi-decade timeline, avoiding volatility is the single riskiest thing you can do. It guarantees the erosion of your purchasing power.
So doing nothing is actually a massive risk.
Yes. And this is where the mechanics of equity ownership become your inflation hedge. Why do stocks historically outpace inflation? Because businesses have pricing power.
Oh, Right, because they can raise prices.
Exactly. If the cost of raw materials and labor goes up by 10%, a dominant consumer goods company just raises the price of their products by 10%. Their profit margins are maintained, and that flows through to the stock price.
So equities act as a pass-through vehicle for inflation.
Yes, because they represent real, tangible economic output. Cash under the mattress has zero pricing power. It just sits there and slowly degrades.
That is such a critical distinction. A market crash is terrifying, but it's temporary. The loss of purchasing power in cash is permanent.
Exactly. History proves that markets rise, fall, and recover. The market rewards patient, non-emotional investors.
But how do we actually put this into practice? Because understanding pricing power is great, but if the listener gets decision fatigue every time they get paid,
Right, if they have to manually decide to invest.
yeah, how do they avoid getting overwhelmed?
Well, the wealthy aren't necessarily the smartest, but they are the most consistent and disciplined. Investing needs to become a habit, not a source of stress. It should be a monthly routine.
Like paying a bill.
Treat it exactly like paying a bill, except this is a bill you pay to your future self.
I love that framing. It's like having a streaming subscription that you literally can't cancel, except instead of binge-watching shows, it's paying you in your 60s.
That is a perfect analogy. You don't actively decide to pay for your streaming service every month. The capital is just swept from your account behind the scenes.
You don't even feel it.
Right. You completely remove the friction of choice. How does this monthly bill mentality change the way an investor looks at their paycheck?
Yeah, how does it?
Well, if we connect this to the bigger picture, this mindset shift changes everything. Instead of asking, how much can I make this week or should I buy today? The investor asks, how much wealth can I build over the next 20 years?
It totally removes the emotion from it.
Completely. It turns wealth creation into simple mechanical discipline, and that automation executes what we call dollar cost averaging.
Which means you're buying no matter what the market is doing.
Exactly. When the money moves automatically, you stop caring if the market is at an all-time high or in a recession. In fact, when the market drops 20%, your automated contribution is just acquiring more shares at a huge discount.
Oh, wow. So a crash actually becomes a good thing for your monthly contribution.
Exactly. It neutralizes the impulse to time the market.
Oh.
You don't have to read dense economic reports. You just let the automated infrastructure do the heavy lifting for you.
So to summarize all this for you, the listener, the stock market creates countless millionaires, but not through luck or insider knowledge.
Nope, just patience.
Patience, discipline, and the sheer force of time. Every year you delay is a year. Compounding cannot work for you.
That's the one variable you can't reverse engineer, time. You have to start learning, start investing, and think long term.
Absolutely. And as we wrap up this deep dive, we want to leave you with a final provocative thought to mull over on your own. Yeah, something to think about. If time is the absolute most powerful asset an investor has, and we know that every dollar invested today multiplies into many more down the road, how does that change the way you value the things you choose to buy today?
Oh, that's a great question.
Right. Like when you're about to make an impulse purchase, do you just see the price tag or do you calculate the thousands of dollars in future wealth you're trading away? Are you willing to trade a little bit of your present for a much larger piece of your future?
It's a heavy calculation, but a necessary one.
It really is. Something for all of us to think about. Keep learning, keep investing, and we will catch you on the next one.